So let's talk today about a little bit of the general consensus of the market. I think there's a lot of interesting things going on. We're hearing a lot about, of course, the usual, the S&D and all that kind of stuff, but we're also hearing a lot about some of the global economic spin-offs and ramifications on this market. John, when you look at the global kind of ag commodity market right now, what's sort of your sense and your feeling?
Uh, Probably the fairest way to put it, Sean, right now is a lot of uncertainty in the shorter term, and it's we see how volatile these markets have been the last couple of weeks, and I mean there's two parts of that. Certainly, there is a certain element of excellent pace of planting in the U.S., good crop conditions up here for the most part. I mean, some wet pockets, by and large, crops are in good shape up here, and so uh, where there maybe is always a little weather premium going in the spring, certainly there's justification for the idea that the crops are in pretty good shape here for the overall. Uh, on the flip side of that, I mean, we know that South American crop has been shrinking, and that's been known for a long time. There's been some weather concerns, particularly in the former Soviet Union in terms of wheat. So there are those dynamics that all play into it, and weather going forward, and all those things. But on top of all of that, there's been a lot of noise recently that has spilt over from the outside financial markets, and Europe, of course, is in the headlines again, and to a certain extent, it always surprises me a little bit that suddenly the market sort of wakes up and realizes that Europe's in terrible shape. I mean, they've always been in terrible shape, and the first Greek bailout wasn't good enough and wasn't going to go very far, and kind of
Yeah.
everybody sort of knows that, but it's almost like they wake up at a certain point and start getting uptight about it, and financial markets start selling off stocks, crude oil, it spills over to the grain markets, and there's certainly been a certain element of that. One of the things that has also maybe started creeping in a little more, and maybe some concerns and some caution about how strong the Chinese economy will be going forward, and there's been some rumblings and some concern about that for a while. One of the things that hit the wires more recently over the last week or so is that they've been canceling some shipments of iron ore and coal that they'd previously purchased. Which people are wondering now, does that mean that maybe their economy is starting to slow down, and that, so whereas the European issue is kind of a big deal from financial market perspective. If you look at it from the grain market perspective, if the Chinese economy is slowing down to the point where it maybe starts impairing demand of ag commodities, that's something that would maybe have a more direct impact from a fundamental perspective.
Right, but we a lot of times we watch channels like CNBC or Report on Business. We'll hear traders talk about, the bulls are in control or the bears are in control. Does this feel like a market that just wants to trade down at this point?
It certainly feels a little heavy, and there's always these things that are ebb and flow, and one of the things about CNBC or a lot of the financial press, they sort of roll with the issue of the day, and it's sort of really the commentary is about an inch deep, so I'd be reluctant to read too much into some of that, but you're right. There's certainly a general feel and some ebb and flow that comes with it, and so if you think, for example, in the grain markets, one of the things that is definitely not helped, particularly from an oilseed perspective, is that the funds were carrying a big long position in soybeans going in, both in terms of outright positions, but also as the long leg of a spread against maybe a short corn or a short wheat position. And so then what ends up happening is, as financial markets start to get nervous, and people start dumping positions, it kind of fundamentals sort of takes secondary to just getting out of positions, taking risk off the table. So if you got a big long position in soybeans, that adds a certain amount of selling pressure, regardless of crop conditions and all the other things that are going on, and so that adds further selling pressure to the market. So and to a certain extent, you could say there's a period of time where maybe the bears do have control, or whatever the case is. These things ebb and flow, and certain things kind of take priority, or sort of capture the headline at a certain time, and but certainly when there's fear, people kind of focus on the negative, no doubt.
Yes. So which commodity right now, as we look between now and harvest time, do you feel the best about?
Well, I would say that the oilseeds have the best story. Now, I think we also have to remember how high oilseed prices are. So, to a certain extent, you have to respect the fact that we're at very high prices. So prices are kind of or the market's kind of, or fundamentals, you could say, are bullish or bearish relative to where prices are at any given time. So we have to respect the fact that oilseed prices are very high. But in terms of the actual fundamental story going forward, uh, barring weather, of course, which always adds a whole lot of uncertainty and who knows what could happen. But assuming reasonably normal weather going forward, oilseeds would have the best fundamental story, either in terms of trading higher or at least at a minimum holding relatively firm, even if other markets start to break lower. There's no doubt that the soy market's going to be extremely tight. We need a big crop in the U.S. The U.S. will have more acres of soybeans going in than what was reported by the last USDA report. We need those acres. We need the yield. There's going to be a tremendous amount of pressure for the U.S. to export huge volumes of soybeans. We need that market to make sure that South America puts in record acres. We need a huge crop out of them, which would come off next March. And really, until that next South American crop comes off next March, the oilseed market will be tight. Now, again, a lot of that can be priced in already. Bumper yields maybe takes a little bit of the edge off of where prices are today, but there is this underpinning factor that unless China completely pulls in their horns, which I don't think is the case. It's just fundamentally very, very tight for that oilseed market between now and next March when that next South American harvest starts to come off.
So does that leave you concerned about the wheat and corn market then?
Well, certainly from the wheat perspective, it's. I don't know if I would say it's a particularly bullish story for wheat, but certainly we have lost some bushels in the FSU. The European crop is a bit smaller. There may be some question as to whether we've been maybe leaking a few wheat acres up here. So I wouldn't say that wheat is necessarily overly bearish. I don't know if it's that bullish. I would maybe describe wheat as being sort of neutral, maybe a little friendlier as we look in the back end of next crop year, depending a little bit on how this weather shakes out. Probably one where there's certainly some downside risk is maybe corn. Again, depending on yield. But if the yield is there and that crop's off to a great start, there's no doubt that the short corn carryout will more or less be solved this coming crop year based on big acres and big yields. So that's one where there's maybe some downside.
Just quickly, is there any concern about ethanol demand at all, or is that sort of just locked in?
That's pretty much locked in, so even as they rein in the subsidies, as long as those mandates are in place, and so the mandates dictate that a certain percentage of gasoline must contain ethanol, that becomes inelastic demand. And so what's going to happen with ethanol is you won't necessarily see demand growth. We've seen demand growth over the last number of years in almost go parabolic. That's sort of plateaued. So we're not going to necessarily see greater ethanol demand, but it'll stay fairly flat at the level that's ultimately dictated by the mandates, unless ethanol can, the economics are such that ethanol can be produced profitably without the subsidies, and that becomes a function of gasoline prices relative to corn. But generally speaking, if at a minimum, the mandates will dictate that a certain amount of corn gets used for ethanol.
Okay, John. Well, thanks a lot, and a great overview of the markets, and we'll talk to you again soon.
Thanks, Sean.